Question 1. Operational review demonstrates that a financial controller, responsible for managing the general ledger within PeopleSoft Enterprise 9, is being pressured by senior management to adjust account balances to meet quarterly earnings targets. The proposed adjustments involve reclassifying certain expenses as capital expenditures and accelerating the recognition of unearned revenue. The controller is concerned that these actions would misrepresent the company's financial position and performance, potentially violating U.S. generally accepted accounting principles (GAAP). What is the most ethically and professionally sound course of action for the controller? Option A. Refuse to make the adjustments, document the pressure and the reasons for refusal, and escalate the matter to the audit committee or legal counsel. Option B. Propose alternative creative accounting methods that might achieve a similar financial outcome without overtly violating GAAP, but still misrepresenting the company's true financial standing. Option C. Implement the adjustments as requested by senior management, assuming they have a broader understanding of business strategy and the need for short-term results. Option D. Ignore the request and continue with standard accounting practices, hoping that the pressure will subside without direct confrontation. The correct answer is A. Refuse to make the adjustments, document the pressure and the reasons for refusal, and escalate the matter to the audit committee or legal counsel. Explanation. The scenario presents an ethical dilemma where a financial controller is pressured to manipulate financial data within PeopleSoft Enterprise 9 general ledger to meet short-term targets. This situation is professionally challenging because it pits the controller's duty to accurately report financial information against the pressure from senior management for favorable results. The core conflict lies in maintaining professional integrity and adhering to accounting principles versus succumbing to external pressure that could lead to misrepresentation. Careful judgment is required to navigate this conflict without compromising ethical standards or regulatory compliance. The correct approach involves refusing to manipulate the data and instead escalating the issue through appropriate channels. This represents best professional practice because it upholds the fundamental ethical principles of honesty, integrity, and objectivity. In the context of U.S. generally accepted accounting principles, GAAP, which would be the governing framework for a U.S.-based entity using PeopleSoft, accurate financial reporting is paramount. Manipulating ledger entries to artificially inflate revenue or reduce expenses violates GAAP and can lead to material misstatements, which are a direct contravention of regulatory requirements enforced by bodies like the Securities and Exchange Commission, SEC, for public companies. Furthermore, professional accounting bodies, such as the AICPA, have codes of conduct that mandate integrity and prohibit deceptive practices. Escalating the issue ensures that the matter is addressed at a higher level, potentially involving internal audit or legal counsel, thereby protecting the organization from future repercussions and upholding the controller's professional responsibility. An incorrect approach would be to comply with the senior management's request to alter the ledger entries. This is a direct violation of U.S. GAAP and professional ethical standards. It constitutes fraudulent financial reporting, which carries severe legal and professional consequences, including potential fines, sanctions, and loss of professional licenses. Another incorrect approach would be to ignore the request and do nothing, hoping the issue resolves itself. This passive approach fails to address the ethical breach and leaves the organization vulnerable. It can be interpreted as tacit approval or negligence, and the controller still has a professional obligation to report or address such pressures. A third incorrect approach might be to attempt a creative accounting solution that skirts the edges of GAAP without outright falsification. While seemingly less egregious, this still undermines the principle of transparency and can lead to misinterpretation of financial performance, ultimately failing to meet the ethical standard of providing a true and fair view. Professional decision-making in such situations should follow a structured process. 1. Identify the ethical conflict and the relevant professional standards and regulations, U.S. GAAP, AICPA Code of Professional Conduct. 2. Gather all relevant facts and documentation. 3. Evaluate the potential consequences of different courses of action, both for oneself and the organization. 4. Consult with trusted colleagues, supervisors, or professional bodies if unsure. 5. Take a clear stance based on ethical principles and regulatory requirements, refusing to engage in unethical or illegal activities. 6. Document all communications and actions taken. 7. Escalate the issue through appropriate internal channels if direct resolution is not possible or if pressure persists. Question 2. Cost-benefit analysis shows that implementing a new automated workflow for journal entry approvals in PeopleSoft Enterprise 9 General Ledger could significantly reduce processing time and associated labor costs. However, this proposed optimization involves consolidating approval levels and potentially reducing the number of individuals involved in the final sign-off. Considering the principles of sound financial management and regulatory compliance, which of the following approaches best balances efficiency gains with the imperative of maintaining robust internal controls and data integrity? Option A. Conduct a thorough review of the existing journal entry approval matrix to ensure that the proposed consolidation maintains appropriate segregation of duties and that all critical control points are preserved, potentially adjusting the workflow to accommodate necessary control steps. Option B. Disable certain less critical audit trail functionalities within PeopleSoft GL to further reduce processing overhead and storage costs associated with the new workflow. Option C. Implement the automated workflow, consolidating approval levels to achieve maximum cost savings, and rely on system-generated audit logs for oversight. Option D. Proceed with the automated workflow as designed, as the primary goal is cost reduction, and any potential control weaknesses can be addressed through post-implementation audits. The correct answer is C. Implement the automated workflow, consolidating approval levels to achieve maximum cost savings, and rely on system-generated audit logs for oversight. Explanation. The scenario presents a common challenge in financial systems implementation, balancing the desire for immediate cost savings with the long-term implications of system design and process efficiency. The core professional challenge lies in evaluating the true cost and benefit of process optimization, ensuring that short-term gains do not compromise data integrity, regulatory compliance, or future scalability. Careful judgment is required to move beyond superficial cost reductions and identify opportunities that yield sustainable improvements. The correct approach represents best professional practice because it prioritizes a holistic view of process optimization. By focusing on streamlining workflows, automating manual tasks, and improving data accuracy within the PeopleSoft General Ledger, it directly addresses inefficiencies that can lead to errors, delays, and increased operational costs. This approach aligns with the principles of good financial management and operational excellence, ensuring that the system supports accurate and timely financial reporting, which is a fundamental regulatory requirement. Furthermore, by considering the impact on internal controls and audit trails, it proactively mitigates risks associated with financial misstatements and noncompliance. An incorrect approach that focuses solely on reducing the number of journal entry approvers without a corresponding review of the approval matrix or segregation of duties would be professionally unacceptable. This would represent a regulatory failure by potentially weakening internal controls, increasing the risk of unauthorized or erroneous entries, and violating principles of sound financial governance. Another incorrect approach that involves disabling certain audit trail functionalities to reduce data storage costs would be a significant ethical and regulatory failure. Audit trails are critical for financial transparency, accountability, and compliance with financial reporting standards. Compromising them undermines the integrity of financial data and exposes the organization to severe penalties and reputational damage. A third incorrect approach that prioritizes the implementation of a new, unproven third-party add-on for automated reconciliation without thorough testing and validation of its impact on PeopleSoft GL data integrity would be a failure in due diligence and risk management. This could lead to data corruption, inaccurate financial reporting, and potential regulatory noncompliance. Professionals should employ a decision-making framework that begins with a clear understanding of business objectives and regulatory requirements. This involves identifying key performance indicators for process efficiency and financial accuracy. The next step is to conduct a thorough assessment of current processes, identifying bottlenecks and areas for improvement. When evaluating optimization strategies, a comprehensive cost-benefit analysis should consider not only direct financial savings, but also the impact on data quality, internal controls, auditability, and system scalability. Pilot testing and phased implementation are crucial for validating the effectiveness and safety of any proposed changes before full deployment. Continuous monitoring and evaluation are essential to ensure that optimization efforts remain aligned with evolving business needs and regulatory landscapes. Question 3. Process analysis reveals that the journal entry posting process in PeopleSoft Enterprise 9 General Ledger is experiencing significant delays, leading to a backlog of unposted entries and impacting month-end close timelines. Several departments have proposed ad hoc solutions to expedite posting, including bypassing certain validation rules and increasing the frequency of manual overrides. Which of the following approaches is the most appropriate for addressing these delays while maintaining financial integrity and compliance? Option A. Immediately implement a policy allowing for the temporary suspension of all journal entry validation rules during peak periods to clear the backlog, with a plan to review and re-enable them after the close. Option B. Focus solely on increasing the number of users with override capabilities for journal entries, assuming that more personnel will naturally expedite the posting process through distributed effort. Option C. Conduct a comprehensive review of the journal entry posting workflow, including an analysis of system configurations, user roles, and transaction volumes, to identify specific bottlenecks and areas for automation or procedural improvement, followed by controlled testing of proposed changes. Option D. Prioritize the most vocal department's proposed solution to bypass specific validation rules, as their feedback indicates a significant pain point, and roll out this change across all departments to ensure consistency. The correct answer is C. Conduct a comprehensive review of the journal entry posting workflow, including an analysis of system configurations, user roles, and transaction volumes, to identify specific bottlenecks and areas for automation or procedural improvement, followed by controlled testing of proposed changes. Explanation. The scenario presents a common challenge in financial systems, identifying and rectifying inefficiencies in a core process like journal entry posting. The professional challenge lies in balancing the need for speed and accuracy with the regulatory imperative for robust internal controls and auditable financial records. A hasty or incomplete optimization can lead to errors, compliance breaches, and ultimately misstated financial reports, which have significant legal and reputational consequences. The correct approach, focusing on a systematic, data-driven analysis of the journal entry posting process, represents best professional practice because it aligns with the principles of sound financial management and regulatory compliance. This method ensures that any proposed changes are well understood, tested, and have a demonstrable positive impact without compromising the integrity of the financial data. Specifically, it adheres to the spirit of regulations that mandate accurate financial reporting and effective internal controls, such as those implicitly required by generally accepted accounting principles, GAAP, and audit standards, which are foundational to financial reporting in the U.S. By involving stakeholders and documenting changes, it also supports auditability and transparency. An incorrect approach that bypasses thorough analysis and testing risks, introducing new errors or control weaknesses. For instance, implementing a change without understanding its downstream impact on reconciliation or reporting could lead to discrepancies that are difficult to trace and resolve, potentially violating internal control objectives. Another incorrect approach, such as relying solely on anecdotal evidence or user requests without objective validation, can lead to suboptimal solutions that do not address the root cause of inefficiencies or may even create new problems. These actions could be seen as failing to exercise due professional care, a cornerstone of ethical conduct in accounting and finance, and could lead to noncompliance with internal policies and external regulations requiring accurate and reliable financial information. Professionals should approach process optimization by first establishing clear objectives and success metrics. This involves gathering data on current performance, identifying bottlenecks, and understanding the root causes of inefficiencies. Next, potential solutions should be evaluated based on their feasibility, impact, and alignment with control objectives. Pilot testing and stakeholder consultation are crucial before full implementation. Finally, ongoing monitoring and evaluation are necessary to ensure the optimization achieves its intended benefits and does not introduce unintended consequences. This structured, evidence-based decision-making process ensures that improvements are sustainable and compliant. Question 4. Market research demonstrates that organizations are increasingly seeking to streamline their financial operations. Considering the PeopleSoft Enterprise 9 General Ledger environment and adhering strictly to U.S. regulatory frameworks such as GAAP and SOX, which approach to process optimization for journal entry processing, would be most professionally sound and compliant. Option A. Prioritizing the elimination of all manual journal entries in favor of system-generated entries, regardless of the complexity or potential for misinterpretation of source data. Option B. Significantly reducing the number of required journal entry approvals across all transaction types to expedite processing times, without altering the underlying data input or validation mechanisms. Option C. Implementing a phased approach to automate journal entry creation and approval workflows, supported by robust data validation rules and comprehensive audit trails, after a thorough analysis of transaction types and approval hierarchies. Option D. Introducing automated journal entries directly from operational systems, without intermediate review or reconciliation steps to minimize manual intervention. Correct answer is C. Implementing a phased approach to automate journal entry creation and approval workflows, supported by robust data validation rules and comprehensive audit trails, after a thorough analysis of transaction types and approval hierarchies. Explanation. This scenario presents a common challenge in financial systems, balancing the need for efficient processing with the imperative of maintaining accurate and compliant financial records. The professional challenge lies in identifying and implementing process optimizations within PeopleSoft Enterprise 9 General Ledger that enhance performance without compromising data integrity or violating regulatory requirements. The chosen approach must demonstrate a thorough understanding of both PeopleSoft's capabilities and the relevant regulatory framework governing financial reporting. The correct approach represents best professional practice because it prioritizes a systematic, data-driven evaluation of existing processes. By analyzing transaction volumes, processing times, and error rates, it allows for targeted improvements that address actual bottlenecks. This aligns with the principles of sound financial management and internal controls, which emphasize efficiency, accuracy, and compliance. Specifically, within the context of U.S. Generally Accepted Accounting Principles, GAAP, and relevant Sarbanes-Oxley Act (SOX) provision, any process change must ensure that financial data remains reliable, auditable, and free from material misstatement. Optimizing processes in this manner supports the integrity of financial statements and strengthens the overall control environment. An incorrect approach that focuses solely on reducing the number of journal entry approvals without a corresponding risk assessment or audit trail would be a significant regulatory and ethical failure. This could lead to unauthorized or erroneous entries, violating SOX requirements for internal controls over financial reporting, and potentially leading to inaccurate financial statements, a breach of GAAP. Another incorrect approach, such as implementing automated journal entries based on incomplete or unverified data feeds, would also be problematic. This bypasses critical validation steps, increasing the risk of material misstatements and failing to meet the standards for reliable financial reporting. Furthermore, neglecting to document and test any process changes would be a failure to adhere to best practices for change management and internal controls, making audits more difficult and increasing the likelihood of undetected errors. Professionals should employ a decision-making framework that begins with a clear understanding of business objectives and regulatory mandates. This involves 1. Assessing current processes to identify inefficiencies and risks. 2. Evaluating potential solutions against both performance enhancement and compliance criteria. 3. Conducting thorough testing and validation of any proposed changes. And 4. Ensuring comprehensive documentation and ongoing monitoring. This structured approach ensures that optimizations are effective, compliant, and sustainable, safeguarding the integrity of financial reporting. Question 5. The audit findings indicate a persistent pattern of unreconciled intercompany balances within the PeopleSoft Enterprise 9 General Ledger, leading to delays in period-end closing and potential misstatements. Which of the following approaches best addresses this process optimization challenge while adhering to sound financial control principles? Option A. Implement automated reconciliation rules within PeopleSoft GL to flag discrepancies. Conduct a detailed root cause analysis for all identified variances and establish standardized procedures for resolving intercompany transaction differences. Option B. Manually adjust the GL balances each period to match the intercompany subsidiary ledgers without investigating the underlying reasons for the discrepancies. Option C. Create a separate, standalone spreadsheet to perform intercompany reconciliation, bypassing the standard PeopleSoft GL reconciliation modules. Option D. Defer the reconciliation of all intercompany balances that exceed a certain threshold the subsequent accounting period, with a plan to address them during the next year-end close. The correct answer is A. Implement automated reconciliation rules within PeopleSoft GL to flag discrepancies, conduct a detailed root cause analysis for all identified variances, and establish standardized procedures for resolving intercompany transaction differences. Explanation. The audit findings indicate a recurring issue with the reconciliation of intercompany transactions within the PeopleSoft Enterprise 9 General Ledger. This scenario is professionally challenging because it directly impacts the accuracy and reliability of financial reporting, which is a cornerstone of regulatory compliance and investor confidence. The pressure to close periods quickly can sometimes lead to shortcuts that, while seemingly efficient in the short term, create systemic risks. Careful judgment is required to balance efficiency with the imperative of data integrity. The correct approach, which involves a thorough root cause analysis of the reconciliation discrepancies and the implementation of automated controls and standardized procedures, represents best professional practice. This aligns with the principles of robust internal control frameworks, such as those implicitly expected under general accounting standards and the principles of good corporate governance. By addressing the underlying causes, the organization strengthens its financial processes, reduces the likelihood of future errors, and ensures compliance with reporting requirements. This proactive stance minimizes the risk of misstatements that could lead to regulatory scrutiny or financial penalties. An incorrect approach that focuses solely on manual adjustments to clear reconciliation differences without investigating the source of the errors is professionally unacceptable. This represents a failure to adhere to the principles of sound financial management and internal control. It creates a false sense of accuracy while perpetuating underlying process weaknesses. From a regulatory perspective, this can be seen as a form of window dressing or a failure to maintain adequate books and records, potentially violating principles of financial integrity. Another incorrect approach, which involves deferring the reconciliation of complex intercompany transactions to a later period without a clear plan for resolution, is also professionally unsound. This delays the inevitable and increases the risk of compounding errors. It demonstrates a lack of commitment to timely and accurate financial reporting, which is a fundamental ethical and professional obligation. This can lead to significant challenges during year-end audits and may result in material misstatements being discovered late in the reporting cycle, potentially triggering regulatory investigations. Finally, an approach that involves bypassing the standard PeopleSoft GL reconciliation process for intercompany transactions in favor of a separate, ad hoc spreadsheet-based reconciliation is problematic. While spreadsheets can be useful tools, relying on them for critical financial processes outside of the integrated system introduces significant risks of data integrity, version control, and audit trail issues. This deviates from the established system controls and can lead to inconsistencies and a lack of transparency, undermining the auditability of financial data and potentially contravening internal control policies and best practices. The professional reasoning process for similar situations should involve 1. Acknowledging the audit finding and its potential impact. 2. Prioritizing a root cause analysis to understand the systemic issues. 3. Evaluating potential solutions based on their ability to enhance accuracy, efficiency, and control. 4. Considering the long-term implications of each approach on financial reporting integrity and regulatory compliance. 5. Documenting the chosen approach and its rationale thoroughly. Question 6. The evaluation methodology shows that the General Ledger team is experiencing delays in journal entry processing due to a multi-step approval workflow. To address this, a proposal suggests streamlining the workflow by consolidating approval steps and reducing the number of required sign-offs, with the stated aim of improving efficiency. Considering the principles of process optimization within a regulated financial environment, which of the following actions best aligns with professional best practices for implementing such changes? Option A. Conduct a detailed analysis of the current journal entry workflow, identifying specific bottlenecks and risks associated with each step, and then design and test revised workflows that maintain necessary controls and segregation of duties before implementation. Option B. Automate the consolidation of approval steps without user input or testing, relying on the system's default settings to manage the new workflow. Option C. Immediately implement the proposed consolidated approval workflow to achieve rapid efficiency gains, assuming that the existing controls are sufficient and any potential issues can be addressed post-implementation. Option D. Reassign journal entry creation and approval responsibilities to a single individual to eliminate the need for multiple sign-offs, thereby significantly reducing processing time. The correct answer is A. Conduct a detailed analysis of the current journal entry workflow, identifying specific bottlenecks and risks associated with each step, and then design and test revised workflows that maintain necessary controls and segregation of duties before implementation. Explanation. This scenario presents a professional challenge because it requires balancing the drive for efficiency with the imperative of maintaining accurate and compliant financial reporting within the PeopleSoft Enterprise 9 General Ledger system. The core tension lies in optimizing processes without compromising the integrity of financial data, which is subject to stringent regulatory oversight. Careful judgment is required to identify and implement improvements that enhance operational flow while adhering to established accounting principles and internal control frameworks. The correct approach represents best professional practice because it prioritizes a systematic, data-driven, and collaborative method for process optimization. This involves a thorough analysis of existing workflows, identification of bottlenecks, and the implementation of changes that are validated through testing and user feedback. This approach ensures that any optimizations are not only efficient, but also maintain data accuracy, auditability, and compliance with relevant accounting standards and internal policies. By involving stakeholders and documenting changes, it fosters transparency and accountability, which are critical for regulatory compliance and internal control. An incorrect approach that focuses solely on reducing the number of steps in a journal entry process, without considering the impact on segregation of duties, or the potential for manual overrides to bypass controls, would represent a significant regulatory and ethical failure. This could lead to increased risk of errors, fraud, and non-compliance with internal control objectives, potentially violating principles of financial integrity and accountability. Another incorrect approach that involves implementing automated workflows based on assumptions about user needs without proper testing or validation would also be professionally unacceptable. This could result in system inefficiencies, data integrity issues, and user frustration, undermining the intended benefits of process optimization and potentially leading to reporting inaccuracies. A third incorrect approach that bypasses established change management procedures to implement optimizations quickly would be a critical failure. This disregards the importance of proper testing, documentation, and approval, increasing the risk of unintended consequences. System instability and non-compliance with audit trails and regulatory requirements for system changes. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the current process. Thoroughly document and analyze existing workflows and their associated controls. 2. Identify objectives. Clearly define the goals of process optimization, such as increased efficiency, reduced errors, or improved user experience, while ensuring these align with compliance requirements. 3. Assess risks and controls. Evaluate the potential impact of any proposed changes on data integrity, segregation of duties, and overall compliance. 4. Develop solutions. Propose changes that address identified inefficiencies while mitigating risks. 5. Test and validate. Rigorously test proposed solutions in a controlled environment and gather feedback from end users. 6. Implement and monitor. Deploy approved changes through a formal change management process and continuously monitor their effectiveness and impact on compliance. 7. Document and communicate. Maintain comprehensive documentation of all changes and communicate them effectively to relevant stakeholders. Question 7. The control framework reveals that the month-end closing process in PeopleSoft Enterprise 9 General Ledger is consistently delayed due to a backlog in journal entry approvals. Which of the following strategies would best address this process optimization challenge while maintaining robust internal controls? Option A. Increase the number of required approvers for all journal entries to ensure greater scrutiny, regardless of entry type or value. Option B. Implement a new workflow that dynamically routes journal entries to the most appropriate approver based on predefined criteria, coupled with targeted user training on the PeopleSoft approval process. Option C. Advise users to bypass the standard approval workflow for any journal entry that is critical to meeting the closing deadline. Option D. Mandate that all journal entries be automatically approved without requiring review to expedite the closing timeline. The correct answer is B. Implement a new workflow that dynamically routes journal entries to the most appropriate approver based on predefined criteria, coupled with targeted user training on the PeopleSoft approval process. Explanation: the control framework reveals a recurring bottleneck in the month-end closing process within the General Ledger module of PeopleSoft Enterprise 9. This bottleneck is characterized by significant delays in journal entry approvals, leading to extended closing periods and potential inaccuracies in financial reporting. The professional challenge lies in identifying the root cause of this delay and implementing an effective solution that not only optimizes the process, but also adheres to internal control policies and potentially external regulatory requirements for timely financial reporting. Even though specific external regulations are not detailed for this exam, the PeopleSoft General Ledger environment necessitates a structured approach to process optimization, ensuring that changes enhance efficiency without compromising data integrity or auditability. The correct approach involves a systematic analysis of the existing journal entry approval workflow, identifying specific pain points such as insufficient approver coverage, complex approval hierarchies, or inadequate training on the PeopleSoft system. Implementing targeted solutions, such as workflow re-engineering, leveraging PeopleSoft's approval rules engine for dynamic routing, or providing additional user training, represents best professional practice. This approach ensures that the optimization is data-driven and addresses the actual causes of the bottleneck, leading to a more efficient and reliable closing process. It aligns with the principles of good internal control by ensuring that processes are designed for both efficiency and effectiveness, thereby supporting accurate and timely financial reporting. An incorrect approach would be to bypass the approval process entirely or to implement a blanket policy of overriding approval requirements. This would represent a significant failure in internal controls, potentially leading to unauthorized or erroneous journal entries entering the general ledger. Such actions would undermine the integrity of financial data and could expose the organization to audit deficiencies and regulatory scrutiny if timely and accurate reporting is a mandated requirement. Another incorrect approach would be to implement a superficial fix, such as simply increasing the number of approvers without understanding the underlying workflow issues. This could lead to further delays and frustration, failing to address the root cause and thus not achieving true process optimization. Professionals should approach process optimization by first conducting a thorough diagnostic of the current state, utilizing system data and user feedback. This diagnostic should then inform the development of targeted solutions, prioritizing those that offer the greatest impact on efficiency and control. A phased implementation with clear communication and user training is crucial. Continuous monitoring and evaluation of the optimized process are also essential to ensure sustained improvement and to identify any new bottlenecks that may emerge. This systematic and controlled approach ensures that process improvements are robust, sustainable, and aligned with organizational objectives and control requirements. Question 8. Process analysis reveals that the General Ledger team is spending an excessive amount of time manually reconciling intercompany transactions and processing journal entries that require multiple levels of approval. The goal is to significantly reduce processing time and minimize the potential for manual errors. Which of the following approaches best optimizes the General Ledger process within PeopleSoft Enterprise 9, considering efficiency and control? Option A. Rely on manual spreadsheets to track and reconcile intercompany transactions and require paper-based sign-offs for all journal entries. Option B. Implement automated intercompany reconciliation processes within PeopleSoft and configure multi-level approval workflows for journal entries based on predefined business rules. Option C. Develop custom scripts to bypass standard PeopleSoft journal entry validation and approval steps for high-volume intercompany transactions. Option D. Increase the number of staff dedicated to manual reconciliation and journal entry processing to handle the workload. The correct answer is B. Implement automated intercompany reconciliation processes within PeopleSoft and configure multi-level approval workflows for journal entries based on predefined business rules. Explanation: this scenario presents a common challenge in financial systems, balancing efficiency gains with the need for robust internal controls and compliance. The professional challenge lies in identifying process improvements that enhance operational speed and reduce manual effort without compromising the integrity of financial data or violating regulatory requirements. PeopleSoft Enterprise 9 General Ledger, like any financial system, operates within a framework of accounting principles and potential regulatory oversight, even if specific regulations are not explicitly detailed in the exam syllabus for this question's context. The goal is to optimize processes while maintaining auditability and accuracy. The correct approach focuses on leveraging PeopleSoft's built-in functionalities and established best practices for workflow automation and data validation. This aligns with the principle of designing systems that are both efficient and inherently controlled. By automating reconciliations and implementing automated approval workflows, the organization reduces the risk of human error, speeds up processing times, and ensures that transactions are reviewed and approved according to predefined rules. This proactive approach to process optimization, which prioritizes control and compliance within the system's design, represents best professional practice. It demonstrates an understanding that efficiency should not come at the expense of accuracy and adherence to internal policies and potential external reporting standards. An incorrect approach that bypasses standard control mechanisms, such as directly manipulating journal entries without proper authorization or documentation, introduces significant risks. This could lead to unauthorized transactions, data inaccuracies, and a breakdown in the audit trail, making it difficult to trace the origin and approval of financial data. Such actions could be considered a failure of due diligence and a disregard for internal control principles, which are foundational to sound financial management. Another incorrect approach might involve implementing a quick fix that creates manual workarounds, thereby negating the benefits of the system and increasing the likelihood of errors. This demonstrates a lack of strategic thinking about process optimization and a failure to fully utilize the capabilities of the PeopleSoft system. A third incorrect approach could be to ignore the need for user training, leading to improper system usage and potential control bypasses, even with well-designed processes. A professional decision-making process for similar situations should involve a thorough understanding of the existing processes, the capabilities of the PeopleSoft system, and the underlying principles of internal control and financial reporting. Professionals should prioritize solutions that enhance efficiency through automation and system-driven controls, rather than manual workarounds. They should also consider the impact of any proposed changes on data integrity, auditability, and compliance. A structured approach involving process mapping, risk assessment, and testing of proposed solutions is crucial before implementing any significant changes. Question 9. The performance metrics show a consistent slowdown in the processing of journal entries within the PeopleSoft Enterprise 9 General Ledger module, leading to delays in the month-end close. This slowdown is impacting the ability to reconcile accounts in a timely manner, raising concerns about the completeness and accuracy of the preliminary financial statements. What is the most appropriate immediate course of action for the finance department to address this situation? Option A. Initiate a detailed review of the GL transaction processing logs and system configurations to identify the root cause of the performance degradation and its impact on data integrity. Option B. Focus solely on accelerating manual reconciliation efforts to compensate for the system slowdown, without investigating the underlying cause of the GL processing issues. Option C. Immediately begin manually adjusting and overriding GL entries to expedite the closing process, deferring a full investigation until after the financial statements are issued. Option D. Escalate the issue to senior management for a decision on whether to halt all GL processing until the performance problems are resolved, regardless of the impact on the closing schedule. The correct answer is A. Initiate a detailed review of the GL transaction processing logs and system configurations to identify the root cause of the performance degradation and its impact on data integrity. Explanation: this scenario presents a professional challenge because it requires balancing the need for timely financial reporting with the integrity of the general ledger data. The performance metrics indicate a potential systemic issue within the PeopleSoft Enterprise 9 General Ledger module that is impacting the accuracy and completeness of financial data, which is a critical component of regulatory compliance. The challenge lies in identifying the root cause of the performance degradation without compromising the ongoing financial closing process or introducing further data inconsistencies. The correct approach represents best professional practice because it prioritizes a systematic, data-driven investigation that aligns with the principles of internal control and financial reporting integrity. By initiating a detailed review of the GL transaction processing logs and system configurations, the finance team is adhering to established audit trails and control frameworks. This methodical approach ensures that any identified issues are properly documented, understood, and resolved, thereby safeguarding the accuracy of financial statements and meeting the reporting obligations mandated by relevant accounting standards and any applicable U.S. Generally Accepted Accounting Principles, GAAP, or Securities and Exchange Commission, SEC, regulations for publicly traded entities. This proactive stance minimizes the risk of misstatements and ensures that the financial data presented to stakeholders is reliable. An incorrect approach that involves immediately overriding or manually adjusting GL entries without a thorough investigation would represent a significant regulatory and ethical failure. Such actions bypass established internal controls, create an unreliable audit trail, and could lead to material misstatements in financial reports. This directly violates the principles of accurate financial reporting and could be construed as an attempt to conceal underlying system problems, which is a serious ethical breach and a violation of regulatory requirements for transparency and accuracy. Another incorrect approach, such as deferring the investigation until after the financial close, poses a risk of perpetuating data integrity issues. Delaying the resolution of performance problems that affect GL data could lead to the reporting of inaccurate financial information, potentially resulting in non-compliance with reporting deadlines and standards. This lack of diligence in addressing critical system performance issues that impact financial data is professionally unacceptable and could have legal and financial repercussions. The professional decision-making process for similar situations should involve a structured approach. 1. Acknowledge and document the observed performance issues. 2. Prioritize the investigation based on the potential impact on financial reporting and regulatory compliance. 3. Assemble a cross-functional team, e.g., finance, IT system administrators, to conduct a thorough root cause analysis. 4. Utilize system logs, configuration settings, and transaction data to identify the source of the problem. 5. Develop and implement a remediation plan that addresses the root cause while minimizing disruption to ongoing processes. 6. Document all findings, actions taken, and resolutions. 7. Communicate findings and resolutions to relevant stakeholders. 8. Implement preventative measures to avoid recurrence. Question 10. Strategic planning requires a comprehensive approach to implementing new financial system modules. Considering the primary objective of accurate financial reporting in accordance with U.S. Generally Accepted Accounting Principles, U.S. GAAP, which of the following implementation strategies for PeopleSoft Enterprise 9 General Ledger best balances regulatory compliance, system performance, and user adoption? Option A, an implementation strategy driven primarily by IT performance metrics and system speed optimization, with compliance as a secondary consideration. Option B, a phased implementation that prioritizes core GL functionalities and US GAAP compliance requirements, followed by subsequent rollouts of advanced modules. Option C, an approach that focuses exclusively on end-user convenience and ease of use, deferring complex compliance-related configurations until later stages. Option D, a simultaneous rollout of all available GL modules to expedite the full system deployment and maximize immediate user access. The correct answer is B, a phased implementation that prioritizes core GL functionalities and US GAAP compliance requirements, followed by subsequent rollouts of advanced modules. Explanation. Scenario analysis. This scenario presents a professional challenge related to the implementation of new accounting standards within a PeopleSoft Enterprise 9 General Ledger system. The challenge lies in balancing the need for accurate financial reporting, compliance with U.S. generally accepted accounting principles, U.S. GAAP, and the efficient utilization of system resources. Stakeholders have differing priorities. The CFO is focused on compliance and reporting accuracy, the IT director is concerned with system performance and integration, and the end users, accountants, are focused on ease of use and workflow efficiency. Navigating these competing interests while ensuring the integrity of financial data requires careful consideration of both technical and regulatory aspects. Correct approach analysis. The correct approach involves a phased implementation strategy that prioritizes core accounting functionalities and compliance requirements first. This aligns with U.S. GAAP, which mandates accurate and timely financial reporting. By focusing on the essential GL chart of account structure, journal entry processing, and standard reporting before introducing more complex modules like intercompany transactions or advanced allocations, the organization ensures that the foundational elements of its financial system are robust and compliant. This phased approach minimizes the risk of errors in critical financial data and allows for thorough testing and validation of compliance-related features. It also provides a stable platform for subsequent enhancements, ensuring that user adoption is smoother as they become familiar with the core system before encountering more intricate functionalities. This methodical approach is best professional practice as it directly addresses the primary objective of financial systems, to provide reliable financial information in accordance with regulatory requirements. Incorrect approaches analysis. Implementing all GL modules simultaneously without proper prioritization or testing poses significant risks. This approach could lead to system instability, data corruption, and ultimately, noncompliance with U.S. GAAP due to the inability to accurately capture and report financial transactions. The complexity of integrating multiple new functionalities at once increases the likelihood of errors and makes troubleshooting difficult, potentially delaying financial reporting and impacting decision-making. Focusing solely on IT performance metrics and system speed without adequately addressing U.S. GAAP compliance requirements is a critical regulatory failure. While system performance is important, it cannot supersede the legal and ethical obligation to adhere to accounting standards. This could result in inaccurate financial statements, leading to potential penalties, reputational damage, and loss of investor confidence. Prioritizing end-user convenience and ease of use above all else, without a strong emphasis on U.S. GAAP compliance and system stability, is also an unacceptable approach. While user adoption is important, it should not come at the expense of accurate financial reporting. This could lead to workarounds that bypass proper controls, resulting in data inaccuracies and noncompliance with accounting standards. Professional reasoning. Professionals tasked with implementing PeopleSoft Enterprise 9 General Ledger must adopt a decision-making process that begins with a thorough understanding of the regulatory landscape, specifically U.S. GAAP in this context. This involves identifying all mandatory compliance requirements and prioritizing them. Next, they must assess the technical implications of these requirements on the PeopleSoft system, considering performance, integration, and data integrity. Stakeholder input is crucial, but it must be filtered through the lens of regulatory compliance and business objectives. A risk-based approach, where potential failures are identified and mitigated, is essential. This involves developing a phased implementation plan that addresses critical compliance needs first, followed by less critical functionalities, with continuous testing and validation at each stage. Communication with all stakeholders throughout the process is vital to manage expectations and ensure alignment. Question 11. The monitoring system demonstrates an unusual variance in the accounts receivable aging report for a specific customer, indicating a potential discrepancy in recorded revenue. The accounting team is under pressure to finalize the monthly close. What is the most appropriate course of action to ensure the integrity of the general ledger? Option A. Proceed with the monthly close as scheduled, noting the variance for future review, as the primary objective is timely reporting, and minor discrepancies can be corrected in subsequent periods. Option B. Manually adjust the accounts receivable balance to align with the expected figure, assuming the system has a minor reporting glitch, and proceed with the monthly close. Option C. Immediately investigate the source of the variance by reviewing supporting documentation for the transactions in question and consulting with the sales and collections departments to understand the business context before proposing any adjustments. Option D. Reverse the most recent large transaction associated with that customer, as it is the most likely cause of the variance, and address any further issues after the close. Correct answer is C. Immediately investigate the source of the variance by reviewing supporting documentation for the transactions in question and consulting with the sales and collections departments to understand the business context before proposing any adjustments. Explanation. This scenario presents a professional challenge because it requires balancing the need for timely financial reporting with the integrity of the general ledger data. Monitoring system has identified a discrepancy, and the immediate pressure to close the period and report can lead to hasty decisions that compromise accuracy. Careful judgment is required to ensure that any adjustments made are properly documented, authorized, and aligned with accounting principles and internal controls. The correct approach represents best professional practice because it prioritizes data integrity and adherence to established accounting procedures. By investigating the root cause of the discrepancy before making any adjustments, the accounting team ensures that the general ledger accurately reflects the underlying transactions. This aligns with the fundamental principles of accounting, which emphasize accuracy, completeness, and transparency. Furthermore, involving the appropriate stakeholders, such as the business unit responsible for the transaction and internal audit, ensures that adjustments are not only technically correct, but also operationally sound and compliant with internal control policies. This methodical approach minimizes the risk of errors, fraud, and misstatements in financial reports, thereby upholding the credibility of the financial information. An incorrect approach of directly reversing the transaction without investigation is professionally unacceptable. This fails to address the underlying issue, potentially masking a systemic problem or even a fraudulent activity. It violates the principle of accurate record keeping and can lead to misstated financial statements. Ethically, it demonstrates a lack of due diligence and a disregard for the accuracy of financial data. Another incorrect approach of manually adjusting the balance to match the expected outcome without proper documentation or authorization is also professionally unacceptable. This bypasses established internal controls and accounting policies, creating a significant risk of error or manipulation. It lacks transparency and can be construed as an attempt to conceal a problem, which is both an ethical and regulatory failure. Such actions undermine the reliability of the financial reporting process and can lead to severe consequences, including regulatory penalties and loss of stakeholder trust. The professional decision-making process for similar situations should involve a structured approach. 1. Identify and understand the discrepancy. 2. Investigate the root cause through data analysis and communication with relevant parties. 3. Consult accounting policies and relevant regulations to determine the appropriate accounting treatment. 4. Obtain necessary authorizations for any adjustments. 5. Document all findings, decisions, and adjustments thoroughly. 6. Communicate the resolution to relevant stakeholders. 7. Consider implementing preventative measures to avoid recurrence. Question 12. Operational review demonstrates that the General Ledger team has identified significant unreconciled balances between the accounts receivable subsidiary ledger and the General Ledger control account. The team is under pressure to close the monthly financial statements promptly. Which of the following approaches best ensures the integrity of the financial data while meeting reporting deadlines? Option A. Conduct a thorough investigation, tracing transactions and reviewing supporting documentation for both the general ledger and the subsidiary ledger to identify the root cause of the discrepancy before making any adjustments. Option B. Inform management that the accounts receivable department is solely responsible for the discrepancy and await their resolution before proceeding with the general ledger close. Option C. Defer the reconciliation of the unreconciled balances to the next accounting period, citing current workload pressures, and focus on closing the current period statements. Option D. Immediately adjust the general ledger control account to match the accounts receivable subsidiary ledger balance to facilitate a timely close. The correct answer is D. Immediately adjust the general ledger control account to match the accounts receivable subsidiary ledger balance to facilitate a timely close. Explanation. Scenario analysis. This scenario presents a professional challenge because the General Ledger (GL) team is tasked with ensuring the accuracy and integrity of financial data, which directly impacts financial reporting and compliance. The pressure to quickly resolve discrepancies without a thorough understanding of the root cause can lead to further errors and misstatements. The GL team must balance the need for timely reporting with the imperative of maintaining accurate financial records, a core responsibility governed by accounting principles and potentially regulatory requirements depending on the entity's reporting obligations. Correct approach analysis. The correct approach involves a systematic investigation to identify the root cause of the unreconciled balances. This aligns with best professional practice in accounting and financial management. By tracing the transactions, reviewing supporting documentation, and collaborating with other departments, the GL team ensures that the resolution is accurate and addresses the underlying issue, not just the symptom. This methodical approach upholds the principle of financial statement reliability, which is a cornerstone of accounting standards and is implicitly expected by any regulatory framework governing financial reporting. It prevents the perpetuation of errors and ensures that the financial statements accurately reflect the entity's financial position. Incorrect approaches analysis. One incorrect approach involves immediately adjusting the GL balances to match the subsidiary ledger without understanding the reason for the difference. This is a regulatory and ethical failure because it prioritizes superficial reconciliation over accuracy. It can lead to misstated financial reports, violating the principle of presenting a true and fair view. This action circumvents proper accounting procedures and can mask underlying control weaknesses or fraudulent activity. Another incorrect approach is to defer the reconciliation indefinitely, citing resource constraints. This is professionally unacceptable as it demonstrates a disregard for fundamental accounting controls and responsibilities. It creates a significant risk of material misstatement in financial reports, which could have serious regulatory consequences if the entity is subject to external audits or regulatory oversight. It also erodes stakeholder confidence in the financial data. A third incorrect approach is to blame another department without conducting an independent investigation. While interdepartmental collaboration is crucial, a GL team's primary responsibility is the integrity of the GL. Shifting blame without due diligence is a failure of professional responsibility and can lead to unresolved issues and continued inaccuracies. It bypasses the necessary steps to ensure the GL is correct, potentially leading to regulatory scrutiny if financial statements are found to be unreliable. Professional reasoning. Professionals should adopt a structured problem-solving approach. This involves 1. Clearly defining the problem, the unreconciled balances. 2. Gathering all relevant information and documentation. 3. Analyzing the data to identify potential causes. 4. Developing and testing hypotheses for the discrepancies. 5. Implementing corrective actions based on the confirmed root cause. 6. Documenting the entire process and resolution. 7. Communicating findings and resolutions to relevant stakeholders. This systematic process ensures accuracy, compliance, and continuous improvement of financial processes. Question 13. Assessment of the most appropriate method for processing and reporting intercompany transactions within PeopleSoft Enterprise 9 General Ledger, considering the need for accurate consolidated financial statements and compliance with reporting standards. Option A. Record intercompany transactions as if they were external, relying on manual adjustments during the consolidation process to correct for the misclassification. Option B. Process intercompany transactions through the standard journal entry process without specific intercompany flags or controls, assuming manual reconciliation will suffice. Option C. Utilize PeopleSoft's dedicated intercompany transaction processing and reconciliation modules to ensure accurate recording, tracking, and elimination of intercompany balances before consolidation. Option D. Defer the recording of intercompany transactions until the end of the fiscal year, consolidating based on available external transaction data. The correct answer is C. Utilize PeopleSoft's dedicated intercompany transaction processing and reconciliation modules to ensure accurate recording, tracking, and elimination of intercompany balances before consolidation. Explanation. This scenario presents a professional challenge related to the integrity and accuracy of financial reporting within a PeopleSoft Enterprise 9 General Ledger system, specifically concerning the proper classification of intercompany transactions. The challenge lies in balancing the need for efficient intercompany reconciliation with the regulatory requirement for accurate and transparent financial statements. Misclassification can lead to material misstatements, impacting investor confidence and potentially incurring regulatory penalties. The correct approach emphasizes adherence to established accounting principles and the system's intended functionality for intercompany accounting. By utilizing the system's dedicated intercompany transaction processing and reconciliation features, the organization ensures that transactions are accurately recorded, tracked, and eliminated appropriately during consolidation. This aligns with the principles of generally accepted accounting principles, GAAP, or International Financial Reporting Standards, IFRS, depending on the applicable jurisdiction for the exam, which mandate accurate financial representation. This approach upholds the ethical responsibility of financial professionals to maintain the integrity of financial data and comply with reporting standards. An incorrect approach that bypasses the system's intercompany functionality and treats intercompany transactions as external would lead to several regulatory and ethical failures. Firstly, it violates the principle of accurate financial reporting by misrepresenting the nature of these transactions, inflating revenue and expenses, and distorting the true financial position of the consolidated entity. This could be considered a breach of professional conduct and potentially a violation of securities regulations if the misstatements are material. Secondly, it undermines the internal control environment by circumventing established processes designed for accuracy and auditability. This lack of transparency and control increases the risk of errors and fraud, which are serious ethical and regulatory concerns. Furthermore, failing to properly reconcile and eliminate intercompany balances before consolidation is a direct contravention of accounting standards, leading to inaccurate consolidated financial statements. Professionals should employ a decision-making framework that prioritizes understanding the business purpose of transactions, consulting relevant accounting standards, and leveraging the capabilities of the financial system. When faced with a choice between expediency and accuracy, the decision must always favor accuracy and compliance. This involves thorough system configuration, proper user training, and regular internal reviews to ensure that financial data accurately reflects the economic reality of the organization and meets all regulatory reporting requirements. Question 14. Comparative studies suggest that when reconciling intercompany transactions within PeopleSoft Enterprise 9 General Ledger, a critical step involves ensuring the accurate elimination of intercompany balances to prevent misstated financial statements. Considering the regulatory framework for financial reporting, which of the following approaches best ensures the integrity and compliance of the general ledger data? Option A. Conduct a detailed reconciliation of all intercompany transactions and their corresponding elimination entries, investigating any identified discrepancies to ensure accurate reporting. Option B. Rely solely on the automated intercompany elimination process within PeopleSoft GL, assuming the system accurately handles all transactions. Option C. Defer the detailed reconciliation of intercompany balances to a subsequent accounting period if initial automated eliminations appear reasonable. Option D. Accept the system-generated elimination entries without independent verification, prioritizing the speed of closing the general ledger. The correct answer is A. Conduct a detailed reconciliation of all intercompany transactions and their corresponding elimination entries, investigating any identified discrepancies to ensure accurate reporting. Explanation. The scenario presents a common challenge in financial reporting: the need to ensure the accuracy and completeness of financial data within PeopleSoft Enterprise 9 General Ledger, particularly when dealing with intercompany transactions that require reconciliation. The professional challenge lies in balancing the efficiency of automated processes with the imperative of regulatory compliance and the integrity of financial statements. Mismanagement of intercompany eliminations can lead to material misstatements, impacting investor confidence and potentially incurring regulatory penalties. The correct approach emphasizes a proactive and systematic review of intercompany transactions and their elimination entries. This aligns with the fundamental principles of generally accepted accounting principles, GAAP, and the regulatory framework governing financial reporting, which mandate accurate representation of a company's financial position. Specifically, it adheres to the spirit of regulations requiring robust internal controls over financial reporting and accurate consolidation of financial data. By performing a detailed reconciliation and investigating discrepancies, the accounting team ensures that intercompany balances are properly eliminated, preventing overstatement or understatement of assets, liabilities, and equity. This meticulous approach safeguards the reliability of the general ledger and the financial statements derived from it, upholding professional ethical standards of diligence and accuracy. An incorrect approach that relies solely on the system's automated elimination without independent verification fails to acknowledge the potential for system errors, data input mistakes, or misconfigurations. This oversight can lead to material misstatements in the financial statements, violating the regulatory requirement for accurate financial reporting. Ethically, it represents a failure of due diligence. Another incorrect approach that prioritizes speed over accuracy by accepting the system's output without investigation is also professionally unacceptable. This bypasses critical control points and increases the risk of undetected errors. It directly contravenes the principles of sound financial management and regulatory compliance, which demand thoroughness and accuracy. A third incorrect approach that defers the reconciliation to a later period without immediate investigation introduces significant risk. While some minor timing differences might be acceptable in certain contexts, a systematic deferral of intercompany reconciliation can mask underlying issues and lead to cumulative errors that are far more difficult and costly to resolve later. This approach undermines the principle of timely and accurate financial reporting. Professionals should employ a decision-making framework that prioritizes accuracy and compliance. This involves 1. Understanding the relevant accounting standards and regulatory requirements for intercompany transactions and eliminations. 2. Implementing robust internal controls within PeopleSoft GL to ensure data integrity and proper transaction processing. 3. Establishing a clear reconciliation process for intercompany balances, including defined timelines and responsibilities. 4. Investigating and resolving any identified discrepancies promptly and thoroughly. 5. Documenting all reconciliation activities and resolutions for audit purposes. This systematic approach ensures that financial data is not only processed efficiently, but also accurately reflects the economic reality of the organization, meeting both internal and external stakeholder expectations. Question 15. Compliance review shows that during the recent period end close, a significant number of intercompany transactions were automatically flagged for elimination within the PeopleSoft Enterprise 9 General Ledger system. The accounting team, under pressure to meet the close deadline, applied these eliminations without a detailed review of the underlying business purpose or supporting documentation for each transaction. What is the most appropriate course of action to ensure the accuracy and compliance of the financial statements? Option A. Perform a high-level review of the aging of intercompany balances and eliminate only those that are over 90 days old, as these are less likely to represent active business dealings. Option B. Immediately reverse all intercompany eliminations that were automatically processed and conduct a detailed review of each transaction supporting documentation and business purpose to determine the correct accounting treatment according to U.S. GAAP. Option C. Rely on the system's automated flagging mechanism for intercompany transactions and assume that all automatically flagged items are correctly designated for elimination, as the system is designed for accuracy. Option D. Proceed with the period end close as scheduled and address any potential misstatements related to intercompany eliminations in the subsequent reporting period. Correct answer is B. Immediately reverse all intercompany eliminations that were automatically processed and conduct a detailed review of each transaction supporting documentation and business purpose to determine the correct accounting treatment according to U.S. GAAP. Explanation. Scenario analysis. This scenario presents a challenge in ensuring the integrity and accuracy of financial reporting within the PeopleSoft General Ledger system, specifically concerning the proper classification of intercompany transactions. The difficulty lies in distinguishing between genuine intercompany eliminations required for consolidated reporting and transactions that, while appearing intercompany, represent actual economic events requiring separate accounting treatment. Misclassification can lead to material misstatements in financial statements, impacting investor confidence and regulatory compliance. The pressure to close periods quickly can exacerbate this challenge, leading to rushed decisions. Correct approach analysis. The correct approach involves a thorough review of the underlying documentation and business purpose of each intercompany transaction before applying an elimination entry. This aligns with the fundamental accounting principle of substance over form, which dictates that transactions should be accounted for based on their economic reality rather than their legal form. In the context of U.S. Generally Accepted Accounting Principles, U.S. GAAP, which is the governing framework for this exam, proper classification is crucial for presenting a true and fair view of the entity's financial position and performance. This detailed review ensures that only true intercompany balances that do not represent external economic activity are eliminated, thereby maintaining the accuracy of the consolidated financial statements. Incorrect approach is analysis. One incorrect approach is to automatically eliminate all transactions flagged as intercompany within PeopleSoft without further investigation. This violates the substance over form principle and U.S. GAAP. It assumes that the system's designation is always correct, which is not the case. Such an approach risks eliminating genuine revenue or expense transactions that have occurred between related entities, but represent a sale or service that should be recognized. This would lead to an understatement of revenue and expenses, misrepresenting the operational performance of the consolidated entity. Another incorrect approach is to rely solely on the aging of intercompany balances to determine which ones to eliminate. While aging is important for identifying stale or potentially problematic balances, it does not dictate whether a transaction represents an actual economic event or a true intercompany elimination. Eliminating based on age without understanding the nature of the transaction could lead to the elimination of valid intercompany receivables or payables that are still outstanding and represent legitimate business dealings, thus distorting the financial position. A third incorrect approach is to prioritize speed of period-end close over the accuracy of intercompany eliminations. While efficiency is important, it should not come at the expense of compliance with accounting standards. Rushing the process without due diligence on intercompany transactions can lead to significant errors that require costly restatements later, ultimately hindering efficiency and damaging credibility. This approach fails to uphold the professional responsibility to ensure the reliability of financial information. Professional reasoning. Professionals should adopt a decision-making framework that prioritizes accuracy and compliance. This involves 1. Understanding the business context and the nature of intercompany transactions. 2. Consulting relevant accounting standards, U.S. GAAP in this case, and internal policies. 3. Performing due diligence by reviewing supporting documentation for each transaction. 4. Utilizing system functionalities, like PeopleSoft GL, as tools to facilitate the process, but not as a substitute for professional judgment. 5. Documenting the rationale for all elimination decisions. 6. Escalating complex or uncertain situations to senior management or accounting policy experts. This structured approach ensures that financial reporting is both efficient and compliant with regulatory requirements. Question 16. To address the challenge of a newly acquired business unit operating with a significantly different, internally developed chart of accounts that does not align with the parent company's standardized PeopleSoft Enterprise 9 General Ledger chart of accounts, what is the most appropriate course of action for the PeopleSoft General Ledger Administrator to ensure accurate and compliant financial consolidation? Option A. Allow the acquired business unit to maintain its current chart of accounts within PeopleSoft GL and implement custom reporting solutions to translate its data into the parent company's format for consolidation. Option B. Advise the acquired business unit to continue using its existing manual ledger system and provide periodic data extracts for manual reconciliation into the parent company's GL. Option C. Mandate the immediate adoption of the parent company's standardized chart of accounts within the PeopleSoft GL system for the acquired business unit, requiring remapping of historical and current transactions. Option D. Create a separate, parallel chart of accounts within the PeopleSoft GL system, specifically for the acquired business unit, to accommodate its unique reporting needs. The correct answer is C. Mandate the immediate adoption of the parent company's standardized chart of accounts within the PeopleSoft GL system for the acquired business unit, requiring remapping of historical and current transactions. Explanation. The scenario presents a common challenge in financial reporting, where a business unit's internal accounting practices deviate from established corporate policies and regulatory requirements. The professional challenge lies in balancing the need for timely and accurate financial reporting with the pressure to accommodate local operational needs or perceived efficiencies. This requires careful judgment to ensure compliance without stifling necessary business operations. The correct approach represents best professional practice because it prioritizes adherence to the established corporate chart of accounts and the regulatory framework governing financial reporting. PeopleSoft Enterprise 9 General Ledger is designed to enforce standardized accounting practices, ensuring data integrity and comparability across the organization. By insisting on the use of the corporate chart of accounts, the GL administrator upholds the integrity of the consolidated financial statements, which are subject to regulatory scrutiny. This aligns with the principles of generally accepted accounting principles, GAAP, or International Financial Reporting Standards, IFRS, depending on the jurisdiction and the specific reporting requirements mandated by regulatory bodies. It ensures that all transactions are classified consistently, enabling accurate analysis, auditing, and compliance. An incorrect approach that involves creating a separate, non-standard chart of accounts for the business unit is professionally unacceptable. This would lead to significant reconciliation issues, making it difficult to consolidate financial data accurately. It creates a risk of misstatement in the financial reports, potentially violating regulatory reporting standards and leading to audit failures. Ethically, it undermines the principle of transparency and fairness in financial reporting. Another incorrect approach, which is to bypass the GL system and maintain manual ledgers for the business unit, is also professionally unacceptable. This practice introduces a high risk of errors, omissions, and fraud. It bypasses the internal controls inherent in the PeopleSoft system, making it impossible to ensure the accuracy and completeness of financial data. This directly contravenes regulatory requirements for robust internal controls and accurate financial record-keeping. Finally, an incorrect approach that involves selectively applying corporate accounting policies based on the business unit's preference is professionally unacceptable. Financial reporting standards and corporate policies are designed to be applied consistently across all entities to ensure comparability and reliability. Deviations, even if seemingly minor or driven by local convenience, can lead to misinterpretations of financial performance and position, and can be viewed as a failure to comply with regulatory mandates for consistent accounting treatment. The professional reasoning framework to use in such situations involves a hierarchical approach. 1. Identify the core issue, deviation from established accounting policies and system controls. 2. Consult governing principles. Refer to the Corporate Accounting Policy Manual, the PeopleSoft GL Systems Design Principles, and relevant regulatory pronouncements, e.g., SEC rules for U.S. public companies or equivalent for other jurisdictions. 3. Evaluate impact. Assess the potential impact of the deviation on financial reporting accuracy, internal controls, auditability, and regulatory compliance. 4. Seek clarification and enforce policy. Engage with the business unit to understand their concerns, but firmly reiterate the necessity of adhering to the established framework. Escalate to higher management or the Accounting Policy Committee if resistance persists. 5. Document decisions. Maintain a record of discussions, decisions, and justifications for any actions taken. Question 17. Cost-benefit analysis shows that implementing a new, highly advanced general ledger module in PeopleSoft Enterprise 9 offers significant potential for process automation and enhanced reporting capabilities. However, this module requires extensive user retraining and a substantial shift in current accounting workflows. An alternative, less feature-rich module is available that integrates more seamlessly with existing processes and requires minimal training, but offers fewer long-term automation benefits. Considering the immediate impact on user productivity and the potential for data integrity issues during a complex transition, which approach best balances the organization's need for efficient financial operations with the practicalities of system implementation. Option A. Delay the decision to implement any new module until a future fiscal year when additional resources can be allocated for a more extensive training program for the advanced module. Option B. Implement the advanced module after a comprehensive pilot program with a select group of users, gathering feedback and refining training materials before a phased rollout across the organization. Option C. Prioritize the less feature-rich module to minimize immediate disruption and training costs, accepting the trade-off of fewer long-term automation benefits. Option D. Proceed with an immediate, full-scale implementation of the advanced module, assuming users will adapt quickly to the new system and workflows. The correct answer is B. Implement the advanced module after a comprehensive pilot program with a select group of users, gathering feedback and refining training materials before a phased rollout across the organization. Explanation. The scenario presents a common challenge in financial system implementation, balancing the desire for advanced functionality with the practicalities of user adoption and ongoing support. The core of the challenge lies in the potential for a new feature, while technically superior, to disrupt established workflows and require significant retraining, thereby impacting productivity and potentially leading to errors if not managed effectively. Careful judgment is required to ensure that the chosen solution aligns with both the organization's strategic goals and its operational realities. The correct approach represents best professional practice because it prioritizes a phased implementation and thorough user validation. This aligns with the principles of sound financial system management, which emphasize minimizing disruption, ensuring data integrity, and maximizing user proficiency. By conducting a pilot program and gathering feedback, the organization demonstrates a commitment to user-centric design and risk mitigation. This proactive approach helps to identify and address potential issues before a full rollout, thereby reducing the likelihood of costly errors, rework, and user dissatisfaction. This aligns with general principles of good governance and operational efficiency, which are implicitly supported by regulatory frameworks that expect entities to maintain robust internal controls and efficient processes. An incorrect approach that focuses solely on the immediate cost savings of a less feature-rich option fails to consider the long-term implications of user inefficiency and potential errors. This could lead to higher operational costs down the line due to increased support needs, data reconciliation issues, and missed opportunities for process improvement. Ethically, it could be seen as neglecting the needs of the end users and potentially compromising the integrity of financial reporting if the chosen system is not adequately utilized or understood. Another incorrect approach that advocates for an immediate, full-scale rollout of the most advanced functionality without adequate preparation or testing ignores the inherent risks of change management. This can lead to widespread user confusion, significant productivity dips, and a high probability of data entry errors. From a regulatory perspective, this could be viewed as a failure to implement adequate internal controls, as a poorly understood or implemented system can undermine the reliability of financial data. A third incorrect approach that delays the decision indefinitely due to a fear of change or an inability to commit resources fails to capitalize on potential improvements and can lead to the organization falling behind in its technological capabilities. This can also create an environment of uncertainty and frustration among staff. Professionally, this demonstrates a lack of strategic foresight and an inability to adapt to evolving business needs, which can indirectly impact compliance by hindering the ability to adopt more efficient and controlled processes. The professional decision-making process for similar situations should involve a structured evaluation of all viable options, considering not only the initial costs, but also the long-term operational impact, user adoption, training requirements, and potential risks. A robust change management plan, including stakeholder engagement, pilot testing, and comprehensive training, is crucial for successful system implementation. Professionals should leverage frameworks that promote a balanced approach, weighing technical capabilities against practical implementation realities and the overall strategic objectives of the organization. Question 18. Process analysis reveals a new accounting standard has been issued that significantly impacts revenue recognition for a company using PeopleSoft Enterprise 9 General Ledger. The standard introduces complex criteria for determining the timing and amount of revenue to be recognized. The project team is tasked with configuring PeopleSoft GL to comply with this new standard. Which of the following approaches best ensures accurate financial reporting and regulatory compliance? Option A. Prioritize a rapid implementation of the new standard's core requirements in PeopleSoft GL to meet the upcoming reporting deadline, deferring detailed validation of complex scenarios. Option B. Configure PeopleSoft GL based on the technical documentation of the new standard, assuming standard accounting practices will be automatically accommodated. Option C. Update the chart of accounts in PeopleSoft GL with new accounts suggested by the standard, without consulting accounting experts or performing impact analysis on existing processes. Option D. Engage accounting subject matter experts to thoroughly interpret the new standard's requirements and collaborate with PeopleSoft functional consultants to design and rigorously test system configurations that accurately reflect the standard's accounting treatment. The correct answer is B. Configure PeopleSoft GL based on the technical documentation of the new standard, assuming standard accounting practices will be automatically accommodated. Explanation. Scenario analysis. The scenario presents a common challenge in financial reporting where a new, complex accounting standard needs to be implemented within PeopleSoft Enterprise 9 General Ledger. The professional challenge lies in ensuring that the implementation not only aligns with the technical capabilities of the system, but also adheres strictly to the relevant accounting principles and regulatory requirements. Misinterpretation or inadequate implementation can lead to material misstatements, regulatory penalties, and loss of stakeholder confidence. The pressure to meet deadlines while ensuring accuracy and compliance adds to the complexity. Correct approach analysis. The correct approach involves a thorough understanding of the new accounting standards requirements and how they translate into PeopleSoft GL configurations. This includes identifying the specific GL components, e.g., chart of accounts, journal entry processing, reporting structures, that will be impacted. The process should involve collaboration with accounting subject matter experts to ensure accurate interpretation of the standard, and with IT/PeopleSoft functional consultants to design and configure the system appropriately. Testing and validation are crucial to confirm that the system correctly reflects the accounting treatment mandated by the standard. This approach ensures compliance with accounting principles and regulatory oversight bodies, such as the Financial Accounting Standards Board, FASB in the U.S., which dictate reporting standards. Incorrect approach is analysis. One incorrect approach would be to solely rely on the technical capabilities of PeopleSoft GL without a deep understanding of the new accounting standard. This could lead to a system configuration that is technically sound, but does not accurately reflect the economic substance of the transactions or comply with the reporting requirements of the standard. This failure to adhere to accounting principles is a direct violation of professional accounting ethics and regulatory mandates. Another incorrect approach would be to prioritize speed of implementation over accuracy and compliance. Rushing the configuration and testing phases without proper validation can result in errors that go undetected, leading to non-compliance with accounting standards and potentially fraudulent financial reporting. This disregard for due diligence and accuracy is a serious ethical breach and a violation of regulatory expectations for financial reporting. A third incorrect approach would be to implement changes without proper documentation or audit trails. This makes it difficult to demonstrate compliance to auditors or regulatory bodies and can hinder future troubleshooting or system enhancements. The lack of transparency and accountability is a failure in professional practice and can lead to regulatory scrutiny. Professional reasoning. Professionals should adopt a structured decision-making framework that prioritizes understanding the underlying business and regulatory requirements before configuring the system. This involves 1. Requirement gathering and analysis. Deeply understand the new accounting standard and its implications. 2. Gap analysis. Identify how the current PeopleSoft GL setup needs to change. 3. Design and configuration. Develop a solution that meets both accounting and system requirements. 4. Testing and validation. Rigorously test the configured solution to ensure accuracy and compliance. 5. Documentation and review. Maintain comprehensive documentation and seek review from relevant stakeholders. This systematic approach ensures that financial reporting is accurate, compliant, and auditable, upholding professional integrity and meeting regulatory obligations. Question 19. Operational review demonstrates that while the PeopleSoft Enterprise 9 General Ledger System is configured, there is a lack of clarity regarding the specific security roles assigned to users responsible for journal entry creation and approval. This ambiguity could potentially allow for unauthorized modifications or the bypassing of established review processes. Which of the following actions best addresses this control deficiency? Option A. Conduct a thorough review of all user security roles and permissions within PeopleSoft General Ledger, ensuring that each role adheres to the principle of least privilege and that segregation of duties is maintained for journal entry processing. Option B. Implement a policy that requires all journal entries to be manually documented outside of PeopleSoft for an additional layer of verification. Option C. Rely on the existing system audit logs to detect any suspicious journal entry activity after it has occurred. Option D. Increase the frequency of system-wide data backups to mitigate the risk of data loss due to unauthorized changes. The correct answer is A. Conduct a thorough review of all user security roles and permissions within PeopleSoft General Ledger, ensuring that each role adheres to the principle of least privilege and that segregation of duties is maintained for journal entry processing. Explanation. Scenario analysis. This scenario presents a challenge in ensuring the integrity and accuracy of financial reporting within a PeopleSoft Enterprise 9 General Ledger system. The core issue is the potential for unauthorized or incorrect journal entries to bypass established controls, leading to misstatements in financial statements. This is professionally challenging because it requires a proactive approach to system security and internal controls, rather than a reactive one. The responsibility extends beyond mere system configuration to understanding the business processes and inherent risks associated with financial data manipulation. Correct approach analysis. The correct approach involves a comprehensive review of user security roles and permissions within PeopleSoft General Ledger. This aligns with the fundamental principles of internal control, specifically segregation of duties, and the principle of least privilege. By ensuring that users only have access to the functions and data necessary to perform their job duties, the risk of unauthorized or erroneous journal entries is significantly reduced. This proactive measure is a cornerstone of maintaining financial statement accuracy and compliance with accounting standards, which implicitly require robust internal controls to prevent fraud and error. In a U.S. regulatory context, this directly supports the objectives of the Sarbanes-Oxley Act (SOX) by establishing and maintaining effective internal control over financial reporting. Incorrect approaches analysis. One incorrect approach is to rely solely on periodic system audits without actively reviewing and updating user security roles. Periodic audits can identify issues after they have occurred, but they do not prevent them. This approach fails to implement preventative controls, leaving the system vulnerable to ongoing risks. Ethically, this demonstrates a lack of diligence in safeguarding financial data. Another incorrect approach is to grant broad access to journal entry functions to a limited number of individuals, assuming their trustworthiness. While trust is important, it is not a substitute for proper internal controls. This practice violates the principle of segregation of duties, as individuals with broad access may be able to both create and approve journal entries, increasing the risk of undetected errors or fraudulent activity. This is a direct contravention of SOX requirements for internal controls. A third incorrect approach is to focus exclusively on the technical aspects of system configuration, without considering the business processes that generate journal entries. Understanding how journal entries are initiated, reviewed, and approved in the business context is crucial for designing effective security roles. Ignoring the business process means that security roles might be technically sound, but functionally inadequate to prevent real-world risks. This represents a failure in professional judgment and a disregard for the practical application of controls. Professional reasoning. Professionals should adopt a risk-based approach to system security and internal controls. This involves 1. Understanding the business processes that impact financial reporting. 2. Identifying potential risks and vulnerabilities within those processes and the supporting systems, like PeopleSoft GL. 3. Designing and implementing controls to mitigate those risks, prioritizing preventative controls. 4. Regularly reviewing and testing the effectiveness of these controls. 5. Staying informed about regulatory requirements and best practices in financial system security and internal controls. This systematic approach ensures that controls are not only technically sound, but also practically effective in protecting financial data integrity.